All right, let's jump right in. Today, we're taking a deep dive into S&P Global, a company that's truly at the center of the financial universe. If you're an investor, this is one you got to know about, especially because it's in the middle of a really interesting transformation. So let's get straight to the heart of the investment case.
So let's just get right to the point. Here's the big idea, the main thesis. S&P Global, stock ticker SPGI, isn't just seen as some ordinary data company. The smart money views it as a data tech compounder with a wide moat. What does that mean? It means it's like a fortress, incredibly profitable, with powerful defenses against competitors and a proven ability to grow its value year after year.
And that really brings up two huge questions for anyone looking at this stock, right? First, what exactly are these powerful competitive advantages, these moats that are supposed to protect it? And second, even if they're real, is the company worth the high price tag it usually commands? That's exactly what we're going to figure out.
Okay, so to really get why S&P Global is such a beast, you have to look at how it's built. The company uses a really clever structure that some analysts call a barbell business model. It's all about balancing rock-solid stability with some serious high-growth potential.
Take a look at this chart. It really breaks down that barbell model perfectly. On one end of the barbell, you have market intelligence. Think of this as the stable, steady anchor. It's mostly subscription revenue, super predictable. On the other end, you have the ratings segment. Now, this side is more cyclical, but it's also wildly profitable. When companies are borrowing a lot of money, ratings just prints cash. And when that market slows down, well, that's when the steady subscription business keeps everything on track. It's a brilliant setup.
All right, now for the really cool part. Let's talk about those competitive moats that protect the business. This is the secret sauce, really. It's the reason why would-be competitors have such an incredibly hard time making a dent in S&P Global's key businesses. We're going to break down the three big ones. First up, we've got the network effect. Now, this is a super powerful concept, but it's actually pretty simple. The more people who use a product or a service, the more valuable it becomes for every single person using it. It's kind of like a snowball rolling downhill. And the ratings business is just a textbook example of this. It's a perfect self-reinforcing circle. Companies wanting to issue bonds have to get an S&P rating because all the big investors in the world demand it. And why do investors demand it? Because all the big issuers have one. This creates this incredible duopoly with Moody's, and it's locked in by regulators, making it almost impossible for anyone else to break in. Okay, moat number 2, high switching costs. This one is pretty straightforward. It's when it is just a massive pain in terms of money, time, or effort for your customers to leave you and go to a competitor. And you see this play out perfectly in their market intelligence segment. A platform like Capital IQ isn't just a piece of software that an investment bank uses. No, it gets woven into the very fabric of their daily work. Tearing it out and replacing it would be a huge, expensive, and risky project. And that's exactly why over 90% of the revenue in this segment is stable, recurring subscription money. And finally, the third moat is one we can all intuitively understand, the sheer power of an iconic brand and its intellectual property. We're talking about having a name or a product that is simply seen as the gold standard all around the world.
And you can't talk about iconic brands without talking about the S&P 500. I mean, come on, it's arguably the most important stock market index on the planet. And because of that, S&P Global gets to collect fees on trillions of dollars that are invested in funds that track it. It's basically like owning a royalty on the entire global economy. It's an absolutely beautiful, high-margin business model.
But here's the thing. Management isn't just resting on its laurels. Nope. They are actively reshaping the company to make it even stronger. This is the story of the new SPGI, a huge strategic pivot designed to turn an already incredibly profitable company into an absolute powerhouse.
The big move, the cornerstone of this whole new SPGI plan, is spinning off their mobility business. So just look at the before and after here. Once that segment is gone, the new company will be way more focused, with an even bigger chunk of its business coming from its most profitable, most protected segments like the indices business.
And what's the end game here? It's this number right here, a target-adjusted operating margin of around 50%. Let that sink in for a second. 50%. That is just elite territory. That would put it in the same league as some of the most profitable companies in the world, and it shows you just how powerful the strategic shift could be.
So, okay, the company is a fortress, it's getting even more profitable. What does that actually mean for shareholders? Well, it means the company is an absolute cash-generating machine that is laser-focused on returning that cash to its owners. 52. 52 consecutive years of raising their dividend. That's just incredible. It puts them in this super exclusive club of dividend aristocrats, and it sends a crystal clear signal about the company's financial strength and its ability to thrive through good times and bad.
And look, this isn't just something they've done in the past. It is literally their official policy. Management is on the record saying they plan to return 85% or more of the company's free cash flow right back to shareholders through a combination of those rising dividends and big stock buybacks. You can't get much clearer than that.
All right, so we've covered the good stuff, the really impressive stuff. But that brings us to the final, crucial questions for any investor. Is it a good business? Yes, but what's the right price to pay for it, and what are the big risks that could derail the whole thing?
Now, this table is super important for putting the stock's price in context. You'll notice the market does not value SPGI like it values a regular data provider like FactSet. No way. It puts it in a completely different category with its true peers, other wide-moat giants like Moody's and MSCI. The market recognizes these are special, dominant businesses, and it gives them a premium valuation to match.
Now, I know what some of you might be thinking. A price-to-earnings ratio of 35? That sounds expensive. But hold on. Context is everything here. That's actually trading below its own 5-year average, which is closer to 39. So weirdly enough, even after all its success, the stock isn't actually stretched from a historical perspective. For a company of this caliber, the argument is that today's price is actually pretty fair.
Okay, but let's be real. No investment comes without risks, and SPGI is no exception. The big scary one that's always looming is regulatory risk, that politicians could one day go after the issuer pays model. Then there's the more predictable cyclical risk. A nasty recession would definitely hit the ratings and indices businesses. And finally, there's always execution risk. Management has to pull off this big mobility spinoff and make sure its recent acquisitions work out.
And so, at the end of the day, it all comes down to this one big question. You have a company that's actively reinforcing its impenetrable fortress, and it's aiming for truly elite levels of profitability. For an investor, the debate is simple. Are those powerful moats and that incredible profit engine enough to justify paying a premium for a piece of this data powerhouse over the long haul?